Okay, then let's continue with, as promised in the last video, a description of functional finance, how it differs to the ideas we've seen so far, and how it doesn't suffer from the same setbacks of, well, non-existent confidence values and, well, super rational optimizing agents. Let's begin with Kalecki's view on government deficits. In particular, what we're going to find here is something very interesting, namely the finding that government deficits, when higher, actually boost capitalist profits. Now this results because, well, with the increased demand for consumer goods from the government or in investment goods, this will lead to, well, higher demand for those products will lead to higher earnings and higher profits from the capitalists who own the firms that produce those goods. But let's go through the accounting identities, which leads us to that conclusion. And here we have Kalecki's famous profit equation. Here on the left-hand side, we have the income of all people in the economy. So we have profits and the wage bill, so all the wages added up together. So this is the income approach to GDP. On the right-hand side, now in a closed economy with no governments, we have the consumption of workers, we have consumption of capitalists, and investment. So, an investment, well, is determined by firms, which the capitalists own. Therefore, capitalists are in charge of their consumption decisions and their investment decisions, whereas workers are in charge of their consumption decisions. Now, we're going to assume, we're going to make the classical saving hypothesis, which is to say that low-income earners essentially consume all they earn. They do not save. So workers here consume all they earn. So W is equal to CW, which just leaves us with this, and this. So profits is equal to the consumption out of profits plus investment, which leads to the famous saying that capitalists earn what they spend, right? So when we look at this, because remember, this just follows from an accounting identity, the question is, well, on what side of the identity do capitalists have control over the variables? Do they have control directly over how much they earn? Can they decide, I would like to earn more? No, of course they can't. But they can decide how much to spend on their consumption and investment. So the more they spend, the higher demand there is for the goods in their economy, in the economy. And so, it comes back to them in the form of higher profits. Now, this can confuse some students sometimes because you'll say, well, that just means that capitalists can spend and always get it back. Well, keep in mind that we're talking about the profits of the capitalist class as a whole. So of course you could have capitalists who spend on some goods or on some consumption goods or investment goods, which are not a wise decision, but it leads to the higher profits of those other capitalists who are producing those goods, right? So essentially, just see this as the aggregate that it is. It's not for one particular capitalist; it's for the class of capitalists as a whole. Now, this is the famous profit equation, but now we need to expand on it to talk about government deficits, because of course here so far we've assumed no governments, which is not very useful on a lecture on government deficits. So let's include the governmental sector and net export, so the external sector. So now on the left-hand side we have the exact same idea. We have net profits, so that's what the N stands for, net profits, so netted of taxes, and wages. And this income is equal to the expenditure. So this is equal to the consumption out of wages, consumption out of profits, investment, government expenditure minus taxes, exports minus imports, right? So now we have expanded our identity to include a government and the open economy. Now again, we use the same classical saving hypothesis. So wages is equal to the consumption out of wages. Workers consume all that they earn, which leaves us with simply the open economy government version of the profit equation, which is that capitalist profits are equal to their consumption, their investment, the government deficit, and net exports. So, from this simple accounting identity approach, which must hold given our definition of the accounting identity, we have a very straightforward conclusion. Government deficits are good for profits. They're good for the capitalist class as a whole because it means more demand for the goods that they produce. Which leads to a pertinent question, which is, well, why are business leaders generally opposed to government deficits? And Kalecki, although he didn't write about this in the same article, he wrote a different article, which I think I mentioned in one of the reading groups on, the article was on the political economy of aspects of full employment. And, well, Kalecki's answers to that question, why are business leaders opposed to government deficits? Well, the answer is political. Business leaders fear the government intervention in their industry and a high rate of employment, which gives labor more bargaining power. And what I found really interesting was when rereading the Political Economy of Full Employment paper, it's quite a prophetic explanation or description of this idea of state of confidence. So let me read the quote in full. The level of employment depends on the so-called state of confidence. This gives to capitalists a powerful indirect control over government policy. Everything which may shake the state of confidence must be carefully avoided because it would cause an economic crisis. The social function of the doctrine of sound finance is to make the level of employment dependent on that state of confidence. So this is in his summary at the end. So, business leaders do not want competition from government. Government is a powerful machinery. They don't want to compete against the government. More than that, governments can subsidize its goods if it were to produce its own goods and so on. But on top of that, even if the government doesn't even get involved in direct competition with business, the increase in employment caused by government intervention is likely to increase the power of unions and give them more bargaining power. So in order to break down this linkage, according to Kalecki, business leaders basically ensure that sound finance is the accepted sort of common theory or common knowledge amongst policymakers. Of course, we must keep our house in order. We cannot spend more than we earn, and so on. And in so doing, neglect the obvious facts that a government is not like a household, because you or I do not have a central bank in our back pocket that can finance our spending, whereas governments do. Okay, so now this is the reason for the divide between sound finance and functional finance. But what is functional finance? Well, and a first sort of basic idea of functional finance is, well, depending on where you are in the business cycle, you should use it differently. So you should, be able to restrict and lower your government spending during a boom to level off the sort of over optimistic expectations of the financial sector, for example, and reduce the possibility of financial crisis. But more than that, save and ensure that debt to GDP ratio doesn't get ridiculously high, and then spend during recession or depression. Right. So your deficit should here you've got deficit negative, so you should be running surpluses when the economy is in a boom, and deficits when it's in a slump, in a recession. So that is the principle of countercyclical fiscal policy, which I'm sure most of you will know by now. Anyway, functional finance, this is much more juicy. So it goes back to Abeloner's contribution in 1943, which we can summarize as having sort of three main claims. First, government deficits are in themselves neither good nor bad. There is no moral component. There is no, I should say there is no economic component where we can say, well, deficits are always good or bad. No, it really just depends what you do with them. Secondly, there is no financial constraints on a government backed by a central bank. Just like I kind of mentioned, having a central bank, the ability to create the currency that everyone uses for goods, the payment of goods and services, is a fundamental game changer in terms of what it means for your financial constraints. Thirdly, deficit spending as a means of achieving full employment will lead to a public debt to GDP ratio that converges to a finite value, as in, government deficits may be sustainable. Not only, should you not avoid government deficits, you can increase the government deficit, and knowing that doing so will increase the GDP such that the increase in debts will be met by an increase in GDP, leading to a GDP ratio that doesn't just blow up. It doesn't just, become completely unsustainable. So GDP is directly boosted by government spending, right? So the GDP goes directly into, government spending goes directly into GDP, into income of the nation. But of course, that has multiplier effects as well. For every euro that the government spends, a fraction of that will be saved and the other fraction will be consumed or invested. Well, will be consumed, I should say. Interest paid by the governments to rentiers who finance the deficit will in turn also be spent. So in a closed economy, there is little way it cannot have a demand boosting effect. So all that increase in income caused by that government expenditure then leads to higher tax revenues as well that the government can use for its own purposes. Okay, but let's get a bit more technical. What is the limits to functional finance? What is a debt to GDP ratio that is sustainable? Well, one of the most widely cited and first limits found or discussed is that by Doma in 1944. The real rate of growth of output must be greater than the real rate of interest on debt net of taxes. So if you have a rate of growth greater than the real rate of interest, that, according to Doma and his model, means that you can increase the amount of debts without it becoming explosive and unsustainable. And that kind of makes sense from just a purely intuitive point of view. If your ability to pay, so your income of the economy as a whole, and keep in mind that taxes are like a constant share of income. So if the income is increasing and therefore tax revenue is increasing as you take a constant share of that income, then as long as that increase in income is greater than the amount you have to pay in interest on that debt, then you shouldn't have a debt problem in terms of financing that debt. Okay, but this is a relatively simple model, and I haven't gone through the maths here, but what we can do is use Marc Lavoie's textbook, the post-Keynesian New Foundations textbook from 2014, where he has quite a nice simple model, which I would like to go through step by step with you, just to make sure you see what we're doing here. It is a simple model. It's not quite as simple as Doma's, but it's simple enough. Actually, in so many ways, Doma's model is quite complicated. But anyway, it's simple enough for our purposes. So in Lavoie's model, we have no inflation. We assume that government debt is the only assets that private capitalists or rentiers can hold, right? So this means fundamentally that private wealth is equal to public debts, given the fact that you can't own, for example, shares in a company and so on. So this is just a simplifying assumption. We're also going to assume a closed economy. We're going to assume as well that government successfully pursues functional finance such that the economy is always at full employment output. And perhaps, you could argue about exactly what full employment output is, but, let's say it's when you have an unemployment rate of 3 or 4% or something, quite low. And this full employment output growth rate is then GN, so some sort of natural growth rates, although you should probably avoid the word natural. So this just means that our income, or GDP, is equal to the full employment GDP, which always grows at a rate of GN each year. Yeah. So today's GDP is last year's GDP times 1 plus the rate of growth. Yep. Okay. Now let's define disposable income, as is always done, as GDP or income net of taxes plus interest payments net of taxes. Why interest payments net of taxes? Well, because of course the interest payments that capitalists receive is their income, which can be used for consumption, right? Okay, and now we're going to, so this leads to our statement here. Disposable income is equal to the income that is not taxed plus the interest payments received that is not taxed, where V here is just the stock of wealth, yeah, which is of course the stock of public debts. So the interest rate times that stock of debts gives you the interest payment, and -1 just means from the last period. Yeah? Now, let's assume that this proportion, SYD, so this is the saving out of disposable income. Yeah, well, let's assume that's what the SYD means, and that CV of wealth is dissaved. So this is the consumption out of wealth. So assume you have, you're worth 1 million euro. Then if CV is 2%, then it means you consume 2% of 1 million every year. So you're dissaving. Yeah. So then we can well, estimate, or no, not even estimate. We can derive the saving of the private sector, which is the increase in wealth. So this is what V minus V from the last period is, which is saving of each period minus dissaving, essentially. Yeah. So that will give you the change in the stock of wealth. Let's expand. So inserting for YD, we have this phrase here. So we're not doing anything funny except a bit of algebra. And then we get our expression for the wealth in any given period as a function of the income of the last period and the wealth of the last period. So here I've just reprinted the same condition, except now I've divided the whole thing by y. Why? Because we've got V, which is the stock of debts, and we've got Y, which is GDP. So here we have essentially our debt to GDP ratio. This is what we've been looking for, right? And on the right-hand side, we have the same expression as last time, except divided by Y. We can simplify a great deal. We know that Y, down here, that we have just divided by, is equal to 1 plus GN times the full employment output of the last period. So if we insert that there, this whole left-hand side, this term, simplifies to this. And the right-hand side, through a bit of algebraic manipulation, just simplifies to this. So now, the crucial thing to recognize is that we have the debt to GDP ratio as a function of its previous value. Yeah? Notice in particular, well, yeah, well, let's leave it there for a second. Let's just say we have the debt to GDP ratio as a function of its previous value. So in some sense, we can just simplify to this form where A is this term here and B is the coefficient, the thing multiplying the V over Y term here. So that we can rewrite it in this simpler form here. The crucial thing to recognize is that B, this quotient, this ratio here, it has to be less than or equal to 1 in order for debt to GDP not to become unsustainable. Now we could go into all the maths behind why that is the case, but in some sense it's a very intuitive statement. It's just saying that if you have an increase or change in the debt to GDP ratio in the last period, as long as this coefficient isn't greater than 1, then we know that it's not going to create a sort of sort of upward trending curve of Vy, if you imagine on the y and x-axis. It's not going to look like this. It's going to plateau a bit more like this, yeah, over time. So t on the x-axis and the debt to GDP ratio on the y-axis. So it's going to plateau if b is less than or equal to 1. Yeah. Okay. So in order then to analyze the conditions under which the debt to GDP ratio is sustainable, is non-explosive, we just need to take this term, b, which stops here, yeah, here, and set it equal to less than or equal to 1. and rearrange, and we find that the public debt to GDP ratio converges, as in it in the long run approaches a steady value when when the tax rates, 1 minus the tax rate times the interest rates is less than the natural growth rate times consumption out of wealth divided by saving out of disposable income. Okay, now we can now use this finding, this conclusion from our simple model, just to give an idea of when functional finance is still sustainable. So let's reprint our finding here, our condition, our result. And let's just kind of play around with it and plug in some numbers. So first, let's use what Lavoie uses for the propensity consumer of wealth, which is often estimated to be around 5%, so 0.05. We'll put in for CV, yeah. Propensity to save out of current income, so all income, including the retained profits of firms and so on, is unlikely to be greater than 20%, according to the empirical work that Lavoie cites. And now, even if we allow for the full employment rate of growth to be 0, yeah, which it probably isn't, you could go into debates between green growth and degrowth again and all that, right? But let's just say it could be, 2% or whatever, but let's say it's 0, just for the purpose of the exercise. Then, even for very, let's say, common parameters of the interest rate and the tax rates, so overall tax rates in the economy, like an average across all taxes, yeah, you can see that, well, this side is less than this side, because when you plug in those numbers, you get 0.012, which is obviously 0.25, so you've got a sustainable public debt rate. Now, imagine you're in a really, let's say, strange economy, or let's say overworked economy, where perhaps due to so much demand, like you've got the central bank pursuing policies to combat inflation and so on, and it's got interest rate at 20% and tax rate at a lower rate. Even in this, quite frankly, unrealistic setup, you can still pursue functional finance without worrying about sustainability, according to our simple model here. Yeah. So you can play around with the numbers and kind of think of ways in which what the limits are, but we can see that even under these high rates of interest, where you're paying so much just to service the outstanding debts, 20% is extremely high, of course, you still have a sustainable public debt to GDP ratio, according to the functional finance approach. So, some caveats after a summary first. Only in extreme circumstances will public debt not be sustainable. Yeah, it will not converge to a finite value, only in the most extreme circumstances, according to the functional finance approach. First caveats. Here we have a closed economy, and we must accept that in an open economy, interest payments will also flow abroad as well, which will dampen any increase in domestic demand and the increase in GDP. So the threshold for sustainable debts will therefore be likely lower than the one we have explored here. How much lower is a matter for, well, probably empirical. Second caveat. Higher debt to GDP ratios imply higher income for households that save, the rentiers, right? So if the interest rate is high, this is even more of a redistribution towards those households. So the implication here is that debt may be stable, but still may have undesirable effects on distribution. Okay? So just because it's a sustainable debt to GDP ratio, it could really undermine our distributional goals. So, that must be kept in mind too. But we've already covered distribution and its effects on growth, so we won't go into it more here. Okay, to summarize what we've seen so far before we have a very brief discussion of corona bonds. Summary, debt has risen in many advanced economies in recent years, but we are by no means at historic highs in most economies except for Japan. The rhetoric of the dangers of high public debt is based on unfounded theory, such as money, hyper-rational agents, or, as Krugman puts it, fantasies about the confidence fairy. Kalecki claims capitalists are adverse to full employment government deficits for fears of public sector encroaching on private sector and over empowering labor and giving them excess bargaining power that, quite frankly, capitalists do not want to deal with due to the amount of uncertainty it causes them. The scope for sustainable functional finance is much higher than most claim or expect, according to the simple model that we have used here.